Right, well, let's say welcome to the latest Hardman Talks. Delighted to be joined today by ICG Enterprise Trust, and we have presenting today Oliver Gardy, who's the Head of Private Equity Investments, and Colin Walsh, who's Managing Director over there. We've also been joined by James Caddy, who heads their Investor Relations team. Without further ado, over to Oliver and Colin.
Thank you, Mark. Good afternoon, everybody. It's a pleasure to be invited to the Hardman Talks, and we very much appreciate your time and interest. As we all know, the last 6 months have been provided a very unusual time for all of us on the business level and on the personal level. Furthermore, it's actually provided a severe stress test also for our portfolio. And it's in times of these where you get a lot of knowledge about what you've done and how the investment strategy works. And I'm very pleased how well our portfolio has performed during this economic cycle of extraordinary volatility and uncertainty. And we are also very proud of the quality of our portfolio, in particular our focus on investing in defensive growth sectors such as healthcare, tech-enabled business services, and technology-enabled, and technology. Now, with that introduction, let's just really look at the numbers, and I'd like to give you a quick highlight on the first 6 months, how our portfolio has performed. So if we can go to page 2 directly, which talks about our highlights, you really see that although we're not obviously ever happy with a negative return, considering the circumstances, we're actually pleased that our net asset value declined by only 1% for the first half, which compares very well to the FTSE All-Share Index, which declined roughly about 18% for the same period. But most encouragingly, we saw that in Q2, the emergence of growth in our portfolio. Back in Q1, we were predicting a sharp decline of our portfolio in NAV in Q1, and then followed by another further decline in Q2. And we are pleased to report that our portfolio declined only by 4% in Q1 and actually started to grow again in Q2 by 3.2%. A further indication that growth is being rebooted is our top 30 portfolio companies have grown their earnings in the last 12 months by 15%, which I think is a great indicator because valuations can flip around, but looking at real actual growth is a great indicator that for our resilience of our portfolio and that our portfolio is back in growth mode. How do we manage these returns? Is really by being very disciplined and sticking to our proven and focused investment strategy, which we'll talk about it in a second. Our balance sheet is very strong with a total of almost £200 million in available liquidity. And despite the pandemic, our portfolio generated about £94 million in realizations. 55 million of those £94 million of realizations came from strategic secondary sales, which allowed us to rebalance the portfolio and furthermore free up capacity for future investments. We think the current market environment is actually quite attractive for future investments, and market dislocation is what we are experiencing tend to be particularly good investment opportunities and phases in private equity. So we're well placed to capitalize on new investments as they arise. We're committed to continue our progressive dividend policy. We paid 5p in Q1 and paid another 5p in Q2. And as I said, we'll continue with that progressive dividend policy. Let's move on to the next page, page 3. As you see here, I don't want to spend too much time on this slide. I think the message is very clear. We have materially outperformed the FTSE All-Share Index benchmark on all parameters. The question really is about what allowed us to be so sustainably, to outperform the benchmark sustainably, and what gives investors comfort that we can continue to do so going forward. And a fundamental part of that is really what I like to discuss more in our next slide on page 4, which is talking about our investment strategy. Stepping back, private equity has outperformed all other asset classes from a long-term perspective. However, private equity has also some inherent risk, particularly when you look at the discrepancy between top-tier managers and bottom-tier managers. They tend to be more than in other asset classes. So there is inherent risk, and you need to address that. So our approach to creating good returns is really looking at about providing superior risk-adjusted returns for our investors. So we don't look only at the return part of the equation. We also spend time and want to make sure that we have an investment strategy which also addresses the risk part of the equation. And what you see here is the light shaded areas is really how we are focused on reducing risk and protecting the portfolio. And on the darker blue shaded areas is how we drive returns. So on the light blue areas, we only focus on buyouts in the mid-market and larger fund managers. Why do we do that? Because when you look at venture capital, loss ratios are 60 to 70%. In my world, it is almost like playing roulette. Very difficult to pick the winner, which is going to float all boats. And therefore, we much rather be on the buyout side, particularly on the mid to large end, where loss ratios are around 10% to 15% with our current managers. We also avoid small cap because here again, that's an area where you have significantly higher loss ratios, 20% plus, because it's much harder to recruit top talent, management teams, CEOs, as well as those managers don't have the resources to really guide and support their portfolio companies in order to make them better companies or to support them during a transformation phase. Big, large fund managers have their own portfolio teams, they have their own operational partners, they have supply logistic chain experts, they have capital market experts, which can all guide and help their portfolio companies become a better company. And that's why we like that space, the mid to large space. And because private equity is a very resource intensive investment strategy, and therefore access to good resources matters. And the next part is developed markets. We try to focus only on European markets and US markets. We don't think you get paid for the risk you're taking in emerging markets. The returns are typically, the median returns in private equity in developing markets are below Europe and the US. And part of the reason is that the ability to exit your assets is much more difficult. There's much more liquidity in Europe and the US. Now, that's how we address risk. How do we drive returns? It's really by getting access and selecting the top tier fund managers. We've been in existence since 1981. We've been close to 40 years in this business. We have seen all the managers. We have developed relationships with them. We've followed them. We know where the good managers are and which managers are leaving, which companies, which firms. And in addition to that, we have a platform with ICG. We have a great platform who is has access and knowledge across the alternative asset space. So we are constantly in touch with with most private equity managers, and through that we get some good access as well experience on who are really the stars in the industry, and that's where we want to park our capital with and invest with them. And then what we like to do, which is what we call our high conviction investments, to kind of leverage the best ideas and the best assets from those managers we have invested with and invest in those assets directly. So we like to be 50% in fund managers and 50% in high conviction investments, which are co-investments, direct investments, as well as ICG investments. That's how we define high conviction investments. And lastly, we like to invest in the high conviction side. We're really focused on defensive growth companies in resilient sectors such as healthcare, business services, technology, And Colin will talk more about what do we mean by defensive growth companies. But to sum it up, it's really about picking companies which are not in cyclical sectors and have a long sustainable growth, or are actually disruptors in certain areas in the sectors and have a superior business model. So your downside is well protected, but you're getting good upside potential. Let's move on to the next slide, which talks about how do we differentiate ourselves in the market. You as an investor have the choice of either in the listed trust sector, investing either in what I would call fund of funds or fund of funds, such as a Harvest or Pantheon, who are great firms and have great access to also access and the ability to select great managers. But they're very passive in their approach because they're just investing in their funds. And therefore, your exposure is very diversified and you're getting exposure over 1,000 to 2,000 companies, but it's very passive. It's difficult to do a proactive portfolio construction. The other side of it is you can invest directly into feeder vehicles, such as directly with private equity funds, such as Apax or HG or an Oakley Capital. But there you're exposed to one fund manager and to their specific specialized investment strategy. And typically you're exposed, the NAV is really driven by a dozen of companies. So it's not very diversified and you're taking concentration risk. What we're trying to do for our investors is really to provide the best of both worlds. So a diversified portfolio of top tier fund managers. Typically we have 75 to 100 companies which really drive the NAV. Our top 30 portfolio companies represent 47% of the overall portfolio. At the same time, so you get the diversification, but at the same time with our high conviction investment model, we can actually proactively construct a portfolio which focusing on the defensive growth companies and resilient sectors, so that we can actually put our own portfolio construction around the kind of portfolio we would like to own, and as we have seen, has been incredibly resilient going through the pandemic. Now you ask yourself, okay, what are the returns and how are you generating that? So in our third-party funds, so roughly, which has been 56% of our portfolio, has generated 14% per year over the last 5 years. And on the high conviction investments, we generated 19%. We like to be 50-50. You'll notice that on the high conviction, we're slightly behind target at 44%. Partly of that's due partly because valuations were quite punchy over the last 12 to 18 months. So we were a bit cautious of putting capital to work. So we were slightly behind plan. We are seeing currently over the last 2 months, a nice pipeline of very high quality deals coming through at better valuations. And so we are expecting that in the next 6 to 12 months, we will get closer back to the 50-50 target. With that, I'll hand it over to Colin, who will talk more about the composition of our portfolio and what we mean by defensive growth.
Perfect. Thank you very much, Oliver. Just moving on now to slide 6. And just before I get into the portfolio, I think it's just worthwhile Oliver's given you a very detailed overview of the strategy, but I think it's worth emphasizing that we believe that not only is the private equity model very well suited to the kind of conditions we're facing at the moment, but in particular, our strategy is especially well designed to be able to cope with the kind of volatility and uncertainty that we're seeing. So what we've seen in the last 6 months amongst our managers is that we tend to back managers who are very operationally focused. So they've had the ability, they've been able to react quickly. And in some cases, that's meant some very sort of significant operational heavy lifting, modifying business models to make them, to make them work in the COVID environment. We've also always prioritized investing in managers that have long track records. And that means that they've got some of the scars from the last financial crisis. They have developed institutional experience of how to manage So even though the GFC is very, very different to what we're facing today, there's still lots of valuable lessons which we don't think you get from investing, for example, in first-time funds or in experienced managers. As Oliver mentioned, we think the mid to large buyouts are more resilient. The kind of companies we're investing in tend to have better quality management teams, but they also have more diversified business models. So we think they're better placed to be able to weather through the storm. And as we look to the future, we've prioritized investing with managers that we think are best placed to be able to take advantage of future market conditions. So managers with a long-term perspective, so often what we found in the past is when you get periods of dislocation, it can be some of the best times to be deploying capital. So just moving on now to slide 7, which gives you an overview of our portfolio. And you can see from the pie chart that we have predominantly exposure to resilient sectors with strong exposure to healthcare and education, business services, technology. It's worth noting, though, that with the high conviction approach means that even in sectors, for example, our second largest sector is consumer goods and services, which on the face of it might seem to be relatively cyclical. But because of our high conviction approach, 5 companies represent around half of the value within that segment. And they're companies like Lee Filter, like PetSmart, like Frenieri. So business models that are very defensive and very resilient, even though they're categorized within that consumer sector. It's also worth noting what we don't have. So certainly compared to public markets, very low exposure to the financial sector, which tends to be more cyclical, and almost no exposure to oil or natural resources. And it's worth noting too that our leisure exposure, obviously a very heavily impacted sector, half of that was to Rimpos, a business which was realized at a significant premium to its previous carrying value in September. So relatively low exposure to leisure as well. Those of you who've been following us for a while will be aware that we've changed our geographic weightings over the last 4 or 5 years. When they first moved over to ICG about 5 years ago, we had just under 50% of our portfolio allocated to the UK and a very small exposure to the US of around 15%. And we've sort of pivoted with a greater, with an expansion of our US investment program and with our UK exposure coming down. And that's a trend which perhaps not at quite the same pace, but which will continue over the next few years. One other point just to emphasize about our portfolio construction is that we're not taking significant single company exposure risk. So Oliver mentioned earlier on that some of our peers, direct investment peers, they have quite high concentration to single companies, whereas some of the more diversified peers have exposure to thousands of companies. We sit somewhat in the middle. We like to think that our portfolio construction results in the performance of our larger companies making a meaningful difference to our NAV performance. But at the same time, our largest company is only 4.5% of our total NAV. So we're not taking significant single company or single sector or single manager risk. So just moving on now to slide 8, and this shows you the impact of our high conviction approach. As Oliver mentioned earlier, our top 30 companies represent just under half of our portfolio, and overwhelmingly they're high conviction investments. So around 80% of the value of that top 30 comes from high conviction investing, and that's typically through co-investments. And you can see here the same bias towards those defensive growth and resilient sectors. And as I said, when we look at our consumer exposure within the high conviction portfolio, they're very resilient, very defensive companies. We're very, very pleased by the performance of the top 30. So over the last 12 months, revenue and EBITDA grew in the double digits by 11% and 15% respectively. That portfolio is valued at a weighted average of 13 times LTM EBITDA, which we think is reasonable given the growth trajectory of the portfolio, and it's levered at just under 4.5 times. Since the period end, 31st of July, we've seen quite good momentum building up in the portfolio, and we've had some good news. I mentioned earlier on that we had the realization of Rimpot. That was announced in June, and the impact of that valuation is reflected in our results of 31st of July. But we did not receive the cash until the 30th of September. So that's a significant realization event for us. We also were pleased to discover to hear about the IPO of Allegro, another one of our top 30 companies. It's an online marketplace, similar in concept to Amazon or eBay, and it operates almost exclusively in the Polish market, where it's a market leader. It's an investment backed by two of our long-standing European investment partners in Simvin and Permira. And as of 31st of July, it represented around 0.6% of our total portfolio. There's been an uplift to the IPO price compared to 31st of July. Unfortunately, we're not able to disclose exactly how much. But what we can say, because it's in the public domain, is that it's had a very successful first week of trading. So the business was admitted to the Warsaw Exchange on Monday, and its first day of trading went up over 60%, and that valuation's held. So there's a significant uplift just from its first week of trading, and representing a business model which is especially well adapted to the pandemic environment, and it's taking advantage of a significant increase in the penetration of e-commerce in Poland. So, in a sense, a lot of the growth of that business has been accelerated because of the pandemic. And that's the reason why valuations jumped, and it was a heavily oversubscribed IPO. And we've also received notification in the last few weeks that one of our US investments has been partially realized. So this is a refinancing. So we continue to retain the upside in the company for the future, but we received an incremental proceeds of around $9.5 million. So all in all, we're very pleased with how the portfolio has some of the momentum that we've noticed in the portfolio since the period end. Moving on now to the next slide, slide 9. Oliver has already discussed a little bit about defensive growth, and I just thought it was worth just re-emphasizing, because it's such a fundamental part of our approach to selecting investments and to constructing our portfolio. And in essence, the concept's pretty simple. We're looking for companies that can grow irrespective of fluctuations in GDP. And what we're typically seeking to do is to identify a theme which drives that growth and which isn't correlated with fluctuations in the economic cycle. I'll just touch on one of those themes, which is the shift towards cloud-based applications. And I think it's particularly topical because in an environment where it's been quite difficult to execute co-investments in the year to date, we did make one co-investment in Visma. Now, Visma is actually a company we've invested in since 2013. It's one of the stalwarts of our portfolio, and we've invested in it alongside a number of different managers, initially with Simvin, one of Europe's leading pan-European buyout managers, then subsequently with both HG and ICG. And we recently participated in a new round of financing alongside HG. And it's a really good exemplar of what we're looking for in a defensive growth company. Visma supplies enterprise management software to small, medium-sized enterprises in Northern Europe, predominantly in Scandinavia. It's got a very diverse customer base. It's got over 1 million customers. It's got a really long track record of delivering outsized top-line growth, but it's also shown an ability to improve its margins as well. It's a fantastic management team. It's a fantastic business model because its products are so mission critical to their customers, and there's very high levels of customer retention, and it's a very, very sort of sticky model. So, it's a really good example of the kind of qualities that we're looking for when we make investments. And of course, that theme of the shift towards the cloud is one which has it's particularly well suited to sort of the working environment that we're facing today, where people are often working remotely. Cloud-based solutions really help to manage businesses when we're all in different places. So just on that, I would encourage you, by the way, if you are interested in our investment approach, we've put some case studies in the packs you'll have received. So towards the back pages of this presentation, there's some more detail on some of our recent investment activity. But with that, I'm just going to pass back to Oliver just to sum up.
Yeah, thank you, Colin. I'll keep it short and sweet. On page 10, our next slide is, as we said before, we're very pleased with the performance of the portfolio considering the circumstances. It has proven to be very resilient to the economic shocks caused by the pandemic. And I think our strategy and our focus on the defensive growth sector has served us well here. But I think what's particularly interesting is that we're very encouraged by the re-emerging of growth in our portfolio. It's not quite there as it was maybe a year ago, but getting very close to that. And as noted before, our portfolio grew 3.2% in the second quarter. And our portfolio of the top 30 companies is at a very robust 15 months growth earnings growing in the last 12 months. So we feel that is a very strong indicator that the portfolio is very robust and is back in growth mode. However, we do remain cautious due to the second wave of rising COVID-19 infections. So we are expecting that the economy will have its handbrakes on for a while. But market dislocation, is particularly in private equity, is also creating opportunities. And we're beginning to see an attractive pipeline of investments at better valuations than 12 months ago. And I think with our staying focused on our investment strategy and our strong balance sheet with over 200 million pounds of available liquidity really enables us now to take advantage of these attractive opportunities. And as I said before, we're expecting that we can get our high conviction portfolio back to closer to the 50%. So I think that sums it up, and I'm looking forward to answering any of your questions.
Great, thank you very much, gentlemen. Just as a reminder, the Q&A button is at the bottom of your screen. We have actually got a few questions in already. First one, really, you're sounding very positive on the pipeline, particularly in the high conviction area. Can you give any colour on that? Are there any particular areas which are especially good? Will it change the profile of the portfolio?
Yeah, I think it's not that there's a specific sector which we're shifting to or pivoting to. We actually see a broad quality of portfolio, and the reason why why we're attracted to those investments is really twofold. One is actually threefold. One is that the managers are particularly selective right now, and they don't want to get too aggressive in this environment. So the kind of investments they are presenting to us and their ideas they're presenting to us are usually investments which are been gone through a very selective process. In addition to that, you have a lot more data now in terms of how resilient really those companies have been through a difficult period. A lot of people talk about their recurring revenues and how solid their client base is and how good their backlog is of orders. Now, what has happened during pandemic, it really shakes up and it really has stress tested those business models. So you can, it's much easier to identify really the quality businesses. And thirdly is that valuations are just being adjusted. They are not as aggressive as they were 12 or 18 months ago. And so that's why we feel that the quality of investments we're seeing, we're pretty excited about. In terms of sectors, it's quite broad. We're looking at something in the healthcare sector. We're looking at something in the business services sector. And we're looking at something in the kind of tech-enabled service sector. So those are kind of the areas, and our typical sectors and areas we're looking for, usually companies with high degree of recurring revenues.
Okay, thank you. We've got a couple of questions really around COVID-19. Firstly, you provide the last 12 months EBITDA and revenue growth for your top 30. Could you comment on what's happened over the last 6 months?
Colin, do you want to take that?
Yeah, so broadly speaking, when we look across the portfolio, the vast majority of the portfolio has not been materially impacted by recent events. So if you look at the sectoral exposure, lot of B2B businesses, very few consumer-facing businesses, and those that are pretty resilient, or in the case of one of them, it's already been sold. So we don't disclose quarterly performance, and we don't disclose half-year performance. We never have. But what I would say is that there's a lot of businesses there's a balance of business in our portfolio, but overwhelmingly we don't see significant negative impact. But clearly, when you look, there are some. For example, there are some businesses we have in the education space where there's been quite a severe. So first of all, education's always been something we've loved investing in. It's got a very strong defensive growth profile, but it's something which has, I think it's a fairly unprecedented shock to that business model. Nobody would have anticipated. We have a schools business in the US, runs primary schools and Montessori schools. I mean, nobody ever anticipated you would have a scenario where all of those sites would pretty much be closed for an entire quarter during the school year. So there are some where there is, it's obvious that there's been there will be a little bit of a shock to revenues and EBITDA, but actually.
But then you have also companies like Chewy, or Allegro who have really benefited from this. So I think if you look at the last 12 months, the 15%, the last 6 months would be. Or let's put it differently. If you would have looked at the average LTM growth over the last 2 or 3 years, they have always been kind of in the kind of mid to high teens. And so we're now at kind of their mid-teens. So it's not substantially different. So the 6 months haven't really pulled down the 12 months too much. And therefore we are expecting, certainly if you take it if COVID continues that way, from the top 30, that will still be in the double digits.
Yeah, and if you look at the weightings of our exposures, just looking at the top 10, you've got, some of these businesses, to Oliver's point, you've got PetSmart's our largest. Chewy is performing phenomenally well. Pet ownership is increased dramatically as a result of the pandemic, and there's been a flight to e-commerce. So, it's that business is, and that's reflected in a share price which has more than doubled in the year to date. We've got business like Roompot, which has been sold. It's our third biggest investment. Minimax supplies fire protection services. That's demand for that keeps going. It's generated by regulation. So when I look at, in particular, our top 10, very, very happy with the resilience of those business models. And, of course, there are some things that have been somewhat impacted, but actually from where we are today, we're seeing good path to recovery, even in those businesses.
Great. You commented about picking sort of the managers who have the operational capacity to support their underlying companies. So the question is, what practical support have the managers been able to provide to the companies through COVID-19? So just give a couple of examples of the sort of the practical examples.
Sure. Yeah, let me give you 2 examples. I mean, one is supply logistics. When China got hit by COVID, and then Europe went to a lockdown, and particularly Italy, it was very disruptive for a lot of companies from a supply chain logistics perspective. And a lot of our managers have actually supply chain logistic experts in their portfolio. Sorry, in their staff, in their teams. And those are the kind of people who immediately got parachuted into the companies to sit next to the CEO, the COO, and the purchasing teams to kind of help them think and restructure and rebalance their supply chain. And that is obviously an incredible resource. The other thing is capital market experts. So pretty much all of our private equity firms have a capital market expert in their team, and what they do, or even a whole teams which are 5 to 10 people strong. And what they can do is in a pandemic like what we have seen, where suddenly liquidity really freezes up, and where it's very difficult, and you really need to make sure you have a strong balance sheet and you shore up your balance sheet. Those teams are incredibly helpful to kind of help the CFO of the portfolio companies to kind of get access to the banks, making sure you can get good facilities in place and can react quickly. Because as you can appreciate, during times like this, the banks get overrun with demands, and having teams which are constantly in touch and have these relationships with the banks is really, really helpful for a company to very quickly shore up the balance sheet. And it's not just important from a protection perspective, it also provides buying opportunities. So as a market leader with a strong balance sheet can then take advantage of the smaller companies who might not have had the luxury of an access to capital markets as much as the strong company. It just gives this a lower hanging fruit to kind of do tuck-in, as we call tuck-in acquisitions, or to continue with their buy and build strategy and integrate weaker companies into a stronger platform. So that's really, those are two examples.
Brilliant. Sort of two questions on broadly the same subject. Is there an optimal size for the fund and any potential to return capital if it gets unwieldy as a means to reduce the discount to the NAV? And the other question was, given your discount to NAV, how do you balance buybacks with a known immediate payback against uncertain future investments?
Are you talking about size of the ICG fund or size of the actual private equity funds we invest in?
It actually says the question is just the optimal size for the fund. So I'm guessing they're talking about your okay. Size rather than the managers.
Yeah, I think there is. Let's put it this way: we have there is very little limit in terms of scaling our business. As a matter of fact, I think we can continue to grow and take it actually more advantage of being more scalable in growth and having strong relationships with the managers where your money counts more than maybe than if you have a bigger check to pay for to offer to the managers than a smaller check. So I don't think size is necessarily critical for us on the upside or downside. So we feel the market is huge. We're talking about 4 trillion of private equity assets under management. So we're a very a small piece of it. It's not like we're BlackRock in the private equity world. So there is still a lot of opportunity for us to scale. In terms of discount, that's a great question. Very difficult to give you a clear answer. We do not like to meddle in the markets, so we would like to let the shareholders in the market kind of really determine the right price. We think it's not the right price for most of the time because we think that discounts are traditionally, not just for us, but for the whole sector, are way too large, considering the growth of NAV and considering the strong balance sheets we have and the ability to provide, to deal with potential illiquidity issues. So those are kind of more or less problems of the past. Therefore, I don't think the discounts are correct. And if we would constantly do buybacks in order to correct the discount to a number where we should think it should be, it just wouldn't really be very productive for our investors. However, having said that, if we think there is a particularly stressful situation on the weighing down on the share price, which is a very irregular situation, we will obviously intervene and then use our balance sheet to do a buyback.
Great. You said the multiple was 13 times. There were lots of moving parts to that. Could you just comment on the moving parts?
Sure. Well, so just to be clear, the multiple is 13 times, and the corresponding multiple at 31st January was lower as 11.7 times. So we've had this question a little bit about what's caused that move. And the major change has been that we made a secondary sale of quite a large position that we have in a fund managed by our previous manager, Graphite Capital. If you look back to January, our top 30 portfolio was over 20% allocated to Graphite managed investments. whereas at the 31st of July, that number is now 11%. And the reason that's changed, been contributed to the multiple going up, is that the graphite investments, so which back in January were in our sort of positions 1 to 15 in our top 30 and have now gone down to sort of 16 to 30. They tend to trade, they're in sectors that tend to trade on naturally lower multiples. They tend to be slightly more cyclical. So you'll see things like recruitment businesses, there's oil services, there's industrials exposure. So those companies were on lower valuation multiples, but they've been, in a sense, they've been replaced by companies that are in technology-enabled business services, software as a service, sectors that trade at a naturally higher multiple. So a lot of it is just that change in the mix and the change in the relative weightings of the company. And there's been a little bit of change in the composition as well. So we've had some new entrants into our top 30, like Iris, which is a software as a service business, and that, of course, contributes to the multiple going up. And some of our listed exposure, businesses like Chewy, as I mentioned earlier, that share price has doubled since January. So that's contributed to multiple increasing. That's our largest company, of course. So, but the main thing, in summary, is that graphite secondary. But we would say that has also shifted our portfolio away from being overly UK exposed, and also that we've got a really high quality mix of businesses in our largest 15.
Brilliant. That actually links into one of the other questions. The secondary market sounded a good source of liquidity for you in the first half. What more can you tell us about it?
I think that is definitely an Oliver question.
We constantly monitor our portfolio, and we constantly look for opportunities where we can change the composition of the portfolio to the portfolio we like it to be. And there are, over time, you develop positions in managers which are not core to you anymore, or what we call tail end funds. Or, for example, the graphite piece where we are rebalancing the portfolio. So we're constantly monitoring the portfolio, and we saw a good opportunity, which we actually, a lot of the processes we started off in the first quarter of this year and then got executed later. And that generated the 55 million of proceeds, which we think have a lower growth going forward than if we would reinvest that into an environment which we think is particularly attractive right now. So we wanted to make sure we not just rebalance the portfolio, but also we release capacity to continue to be active in a market environment which we think is actually more attractive and more interesting than it was 12 or 18 months ago.
Brilliant. Got one on the high conviction portfolio. It only made up 10% of the commitments in the first half, and obviously 90% was then to the residual portfolio. Could you say why, and longer term, why are you capping it at 60% rather than 100%?
Okay, so I think the last 6 months, just in terms of overall market activity, were particularly quiet, unsurprisingly. And that meant that there weren't that many large deals being done. And most of our high conviction investing has been through co-investment, tend to be from larger deals. So it's really just a function of we didn't have very many co-investment opportunities. It wasn't that we were turning things down. There just weren't many big deals being done. So it's really just all about deal activity. And as Oliver mentioned earlier, we've seen that recover. So we're seeing a much fuller pipeline at the moment. In terms of why do we cap it at 60%? I think we're just, from where we are today at 44%, we think aiming for 50 to 60% is realistic in the medium term. But I think we've also got to accept that in order to generate that deal flow, we need the core portfolio of top tier private equity managers to generate it. So it's very, very difficult with our model to only have high conviction investments. We need the partnerships with the managers in terms of the primary funds to be able to generate the deal flow. But we're working very, very hard to increase it, given the benefits it provides us that Oliver outlined, namely the performance, importantly, but also the control it gives us over what's in our portfolio.
Brilliant. Just a reminder, if you want to ask a question, it's the Q&A button at the bottom. We've got a couple of questions still to come through, but yeah, we're running close to the end of time. So if you want to ask a question, you just use the button. A very timely one. If Biden wins, capital taxes are going to go up. How's that going to affect you?
Colin, you want to take that? You talk to managers in the US more often.
Yes, so actually this has been a very live topic, and I was on the phone last night with one of our US managers on this precise topic. There's both a short-term and a long-term impact. It's actually quite positive for deal flow in the short term, because fears over the capital gains tax rises. So essentially, Biden is proposing that capital gains from selling owner-managed businesses would basically be at income-like rates. That's actually propelled quite a lot of deal flow from owner-managed businesses. So people are bringing forward their plans to sell businesses. So many of our US firms are reporting that at the moment they're quite busy with opportunities arising from actions happening because of the fear of this tax rise. But most of our managers, they are really sort of sanguine about it. They don't think it's going to materially impact their businesses. Many of the things that Biden's talking about are just reversing a lot of Trump's tax reforms. So they've been used to dealing with this environment before, and they think they can easily go back to it, and they're able to generate great investment returns under the old tax regime. So they'll be able to live with it. And I think that's very much the sort of persistent view, which is, we'd rather the capital gains tax stayed lower from a self-interest perspective, but we can cope with it being higher. I think that's the overall.
And most likely what's going to happen is they're more likely to raise the time until you can actually do the capital gains. So and right now it's 12 months. So what's most likely going to happen that they're going to raise the time limits until you can sell your assets where the capital gains tax rate is applicable. So, which is fine for private equity because typically the average holding period is about 5 years. So,
and also for those political geeks amongst you as well, it's very different to the UK system where we have reasonably detailed manifestos. It's quite vague, and they're just pronouncements. It's just extracts from speeches, and it's not. There's not any detailed proposal, although he has been clear that the capital rates will increase, but there's a lot of ambiguity in the precise nature of the proposals.
Great, we've got one final question, and just gives a minute for anybody else in case they have any questions to come in. I suppose I think I saved the best till last in the best versions of these things.
Sounds ominous.
Yeah. All right, assuming no further questions, and the question is, lots of listed private equity companies are trading at broadly similar discounts. Why should I buy you?
Great question. I think, as I said before, I think the reason why you would buy ICGT is because you get the best of both worlds. You're getting a very nice diversified portfolio of top tier managers. At the same time, you get a very experienced team. We're the oldest listed private equity trust. We've been in existence in 1981. So we have a very experienced DNA and our ability to construct proactively a portfolio which is particularly resilient as it has shown in its numbers. And I think that's what ICGT gives you, the best of both worlds, of a diversified portfolio, but with some exposure to some very attractive companies in the US and in Europe.
Brilliant. Thank you, gentlemen. Thank you very much. With no further questions, we'll conclude the webcast. And just to say thank you again.
All the best. Bye.
Everyone else. Thank you.